Okay, so Warren Buffett's number one indicator is over 200% when the average should be only about 75. I'm just gonna jump straight into it. I don't want to clickbait you guys or anything like that. His number one indicator is called the Wilshire ratio, which basically takes the market capitalization, how much the market's worth, and has it a ratio to how much the US is producing. In this case, currently, we are over 200%, approximately 220 to 230% over. As I said, the average is 75%, and we have seen lows of a little bit below 50% and spikes over 100%. Now, I wanted to make this video because I've heard a lot of talks about a market bubble and if that's coming in 2021. So, what is a market bubble anyways? So, a market bubble is basically when stocks are over extrapolated and rise in price very, very quickly. The prices are so high that they're really disconnected from their true value. This can happen for a multitude of reasons, although very commonly it's a psychological effect where a lot of people are making money in the markets and then their neighbors see that and then decide to buy in as well. There's been many, many market crashes and market bubbles in the past. The most notable is 1929, the Great Depression, 1987, 1999 dot-com bubble, and 2008 financial crisis as well, dealing with mortgages. Although I do want to emphasize that there is a different degree of market corrections, market crashes, or even bear markets, and I want to get into that further. In 1929, the market dropped by about 90%. So in the modern day, we have more financial tools, so we can prevent this from happening. Such as the 2020 crash, it was like 3 weeks. It was a very V-shaped recovery where stocks in the overall market plummeted very quickly. Then the Fed came out and used some magic by printing trillions of dollars, and of course, we got the V-shaped recovery. So I'm just going on historical averages, and I know that as I post this, we've had a couple red days in the past week or so, but that doesn't necessarily mean we're in a crash. Don't be alarmed because a 5% pullback is very common. This happens about 3 times every single year. A market correction happens about every 16 months, approximately a year and a half, where the market drops by about 10%. We've seen this about 11 times in the last 10 years. So again, nothing to be too concerned about. These are just normal market fluctuations. It will happen and it can present very good buying opportunities for value investors. I will get further into that in a moment. A bear market happens every 7 to 10 years when the overall market drops by about 20%. There is a longer recovery than a correction, although it's not the worst case scenario. Now, what is this crazy worst case scenario? That's an entire market collapse. That's when the overall market drops by about 40% or more. We've only seen this a couple times in history. Now, I'm not saying there's going to be a market crash, market collapse, or anything like that in the near future, although it is inevitable that these corrections will eventually happen. The stock market is not all stonks. The market does not always go up, and you guys need to understand that. Although, how can you capitalize on this in the best case scenario and protect yourself? I don't have any set out rules, although I just want to give you guys a couple tips. One, definitely have enough cash on hand for living. This basically means 6 to 12 months of expenses, so if anything happens, like you lose your job or other streams of income, you're not on the street broke. Number 2, definitely diversify your investments. This helps when limiting risk. So when I'm talking about diversifying, I'm not just talking about the stock market as a whole, I'm also talking about asset classes, such as real estate, of course the stock market, gold, silver, and newly emerging crypto. 3, consistently buy into the market. As the market is dropping, you should be buying. As the market is going up, you should be buying. Why do I say this? Why not just time it when it's at the bottom and sell when it's at the top? Well, studies have shown if you just consistently buy into the market, you do better than the people who time the market perfectly. And of course, you do better than any of those people who time the market at the absolute worst time. Now, this is very important, and I want you to listen up. Are you ready? Do not sell because the stock market is going down. If you bought these stocks because of fundamentals and you really like the business, if anything, you should be adding to your position. I've gone over this in my value investing portfolio, which link is in the description. Definitely check that out. The fundamentals should not just change overnight, meaning that business is still the great business that you wanted to buy into. If anything, you're buying it at a cheaper price, allowing for more percentage return back. I want to address 2 more things. That with the current financial tools that we have in the modern day, I really don't know if we will see a market meltdown like we have in the past, such as 1929. I mean, as we saw just last year, the Fed stepped in immediately and started printing trillions of dollars and just was rolling it out to the US citizens. Secondly, I want to point out the shift of money that I've seen in the stock market. The NASDAQ was down about 2.5% the other day, and the Dow was still positive, which was kind of interesting. I'm just thinking out loud on this, although I think people might be taking profits from these large growth tech companies and putting them more into value companies that are cash cows and can produce dividends consistently. Although I really don't know what's happening, that's just a sheer idea. If you like this kind of content, please like and subscribe. It really helps out my small channel. And of course, turn that bell notification on so you can get updated with all the new uploads. It really helps me out. I really appreciate it. And good luck in the markets. And now you know what to do. So, see ya.